Thanks for joining us on Power Lunch. This is Bloomberg Quint. I'm Meera Dugal. Let's get to the headlines. The Nifty and the Sensex recover from day's lows, but still trade 0.33% lower. Airtel reports its largest ever loss since listing as one-off expenses and exceptional items hurt the bottom line. The stock gains on higher revenues per user. GST collections rebound in June to move back above the 1 lakh crore mark after hitting a 4-month low in May. And Donald Trump escalates trade tensions with China, announcing a 10% tariff hike on Chinese imports worth $300 billion. All right, let's first take a look at the equity markets. Yatin is here with us. Afternoon, Yatin.
Afternoon, Neera. And if you look at the markets, this point in time, clearly weak, but we have almost covered half of our losses that we saw on an intraday basis. So we were down over 100 points on the Nifty, but have managed to recover most of the losses that were made in early trade. The Nifty advance decline ratio is also quite weak, one advance for every 2 decline. In terms of gainers, we have Bharti Airtel post-reporting earnings, which were better than the street expectations. On the operating front, the stock is moved up almost 4%. If you look at Bajaj Auto, Eicher Motors, M&M auto stocks, which were at almost 2.5, 3-year lows, have rebounded from those lows. 2 to 3% gains coming in for all of the major auto names. As far as losers are concerned, Coal India, Tata Steel, as well as Wipro, all of these stocks are down anywhere between 2.5% to 3%. ONGC and HCL Techs are also among the heavyweights which are losing steam in early trade. As far as specific stocks are concerned, Ashok Leyland post its earning conference call yesterday has seen some weakness. The stock was down as much as 12% intraday, still down 8% on Ashok Leyland on good volumes. ICICI Bank as well as HDFC Bank, the two private sector banks are down 2% each. And if you look at Idea Cellular, that stock clearly is losing steam. Again, a 3% down for that one.
Yeah, then thanks so much for that. Just going to briefly mention what's happening across money markets as well. Bond markets, currency markets, some notable moves in both of those segments. So you're seeing the rupee depreciate. The dollar has gained overnight, and that's one of the reasons why you're seeing the rupee weaken, about 0.8% lower on the Indian currency. Yields, though, have actually fallen off quite steeply by almost 10 basis points since the morning. The reason for that is both the fact that oil has slipped and, of course, the dollar has strengthened as well. So you've got the 10-year yield dropping about 10 basis points. Just want to briefly mention also what's happening on the liquidity side. The liquidity situation has been easing, and now you're almost in a surplus of near about 1.7 lakh crore, a little bit beyond that. It'll see you on that chart. The last time we had this kind of liquidity surplus, if you look at a longer term chart, is almost as far back as the days after demonetization, if I'm not correct. GST collections, meanwhile, crossed 1 lakh crore in June after falling to a 4-month low in May. Collections were 5% higher than the same period last year. Nikunj Ori has the details. Nikunj.
The government GST collection in June improved over the last month and has crossed the 1 lakh crore mark in June. The total GST collections were around 1.02 lakh crore as compared to 99,939 crore rupees collected in May, and that's an increase of about 6% from the previous year's GST collections. The breakup of tax collected under various heads was central GST was at 17,912 crore rupees. The government collected 25,008 crore rupees as state GST. Integrated GST and compensation cess were 50,612 crore and 8,551 crore rupees respectively. The compliance over the month improved, and total number of GSTR 3B returns that were filed for the month of June was 75.79 lakh as compared to 74.38 lakh filed in the month of May. Besides this, the central government has also compensated states about 17,789 crore rupees for the month of April and May. And remember, the government compensates states once in every 2 months for the losses that they incur in first 5 years of GST's implementation. Over to you.
All right, Nikunj, stay with us. There's another GST-related bit of news coming in. Casino operators and mobile gaming companies are facing trouble under the regime. They could end up paying tax on an amount that is not part of their revenue. Nikunj, what is the problem?
So casino operators and online fantasy gaming platforms in India face currently a big tax problem. The government under the GST regime wants such casino operators to pay tax on all the bets that are placed at casinos, which does not even classify as its revenue or its commission. Now that's a shift from the pre-GST regime, where such casino operators had to pay tax on the commission that they used to earn on all the bets that were placed at casinos. So and also casino operators used to pay tax on the services that they provided at casinos. Now this is a shift from the pre-GST regime, and now the government is asking all these casino operators to pay tax on an amount which does not even classify or come as a revenue for these casino operators. The Directorate General of Goods and Services Tax Intelligence has raised a tax demand of 6,189 crore rupees against Delta Corp, which is the only listed casino operator in India, and this amount 6,189 crore rupees is not even the revenue of Delta Corporation for the last 3 years or since the time GST was implemented. Delta Corp has denied any such notice being issued to the company, but however, an association the company is a part of has made a representation to the Finance Ministry on its behalf. In its representation, the All India Gaming Federation has highlighted the practice in the pre-GST regime and also the practice overseas, which taxes casinos on their commission or their earnings, and not on the revenue that these companies earn, but only a commission or the earnings that these companies get from all the bets that are placed at casinos. Over to you.
Nikash, thanks so much for that. India Post Payments Bank wants to change its business model just a year after it began full-fledged operations. The Postal Department-run lender, a payment bank, now wants to become a lender via the small finance bank route. Advait Rao joins us with the details. He spoke to the CEO, Suresh Sethi. What is the picture? What's going on there?
Thank you, Ira. So Suresh Sethi, the CEO of India Post Payments Bank, says that they're evaluating the model of a small finance bank and how they can transition from a payments bank to a SFB. Essentially, they're in talks with the RBI, and the RBI also will come out with on-tap licensing guidelines by the end of August. So they will wait for these guidelines to come out, and they will see how they can transition from a payments bank to a small finance bank. Essentially, the payments bank industry, there are only 6 out of the 11 licensed entities, only 6 are operational today, mainly because the regulatory restrictions do not allow profitability and the ability to acquire a lot of revenue. The reason is because payments banks cannot lend, provide loans, and therefore they don't earn an interest income, as opposed to they providing interest on the deposits that they gather, which is around 4%. So the sort of margins that they can earn are very compressed, and over time, as the payments industry is getting a lot more competitive, the margins that all the industry players earn from payments services are lower. So in this light, as the industry is evolving and transitioning, they're looking at the SFB model to see if they can provide micro lending towards unbanked segments in rural and semi-urban India. Suresh Sethi says that as of date, they have over 200 crores in deposits with around 85 lakh customers today. They're across 650 branches and have 1.35 lakh touch points or access points for customers.
All right, thanks so much for that. Interesting, quick transition. But of course, this is only an attempt to do this right now. Regulatory approvals are not yet in place. Let's move on. Truck and bus makers are contemplating changing their products mix. Most manufacturers have been betting on heavy load-bearing trucks and tippers to drive sales, but monthly sales over the last year or so have prompted them to rethink that. Yatin's here to explain why. Yatin.
If you look at the commercial vehicle segment, clearly there has been a slowdown. If you look at the registrations data, of course, on a month-on-month basis, there has been, some bit of improvement. But clearly the sales have been coming off. If you can see from the chart, ever since the festive season, the sales were not able to pick up, and the retail sales clearly fell in the last few months very, very steeply. However, there is some, small improvement on a month-on-month basis. Let's, figure out what were the reasons, why there has been some issue with the, commercial vehicle players. The discount in the marketplace is quite high. Competitiveness is increasing, especially when you have a slowdown. In fact, If you look at the inventory levels with dealers as well as discounting, that has increased quite heavily, impacting the profitability not only for the OEMs but also for the dealerships. Now, if you look at the overall sales mix, that is also changing. If you look at the commercial vehicle players, in terms of the slowdown that they're talking about, clearly at this point in time, the slowdown in light commercial vehicles is much slower than what it is for the medium and heavy commercial vehicle space. In fact, LCVs are outperforming the MHCVs at this point in time relatively. Of course, there is degrowth, but not as high as the heavy commercial vehicles. Now, if you look at Tata Motors, Ashok Leyland, the fall is quite steep, including Eicher Motors. Mahindra and Mahindra, not a big player, but still it has a good amount of weight and market share, 16% down for that one as far as light commercial vehicles are concerned. Maruti being an outlier, wherein the super carry sales, the product that they have, sells almost 1,700 units a month. If you look at the heavy commercial vehicles, the fall has been quite steep. Talking about market leader, Tata Motors, 46% decline there. Eicher Motors, the heavy duty segment, the sales were down 47%. Ashok Leyland and Mahindra also a very steep amount of fall. Of course, also reflecting on the share price performance that we have seen recently. When we spoke to Ashok Leyland, they made two things very clear. The ground situation is not that great. Q2 is where we could see some good amount of destocking at dealerships as well as at the factory inventory. And for that, the companies will have to curb production and keep plants shut. Clearly, the situation in the second quarter is not as good as which was expected earlier. Analysts have been cutting the overall volume growth guidance for what they had accounted earlier. So it has been some bit of disappointment. And the segments that we have identified for Eicher Motors and M&M is different, because Eicher Motors considers 3.5 to 15 tonners as light and medium vehicles, and for M&M less than 3.5 tons is considered to be as light commercial vehicles. So clearly the situation on the ground not improving drastically. In fact, what can happen in the next few months or so, the sales mix can change significantly towards the light commercial vehicles versus the medium and heavy duty trucks and commercial vehicles. And of course, at this point in time, given the stress situation, the tight liquidity situation, the companies, including Ashok Leyland, Tata Motors, will have to adjust production and keep plants shut for the inventories to correct moving ahead.
Yatin, thanks so much for that. Bharti Airtel reported its biggest loss since listing in the June quarter, but the headline numbers mask the underlying recovery made by the telecom operator since it shifted focus to fewer, better-paying users. Samit Sarkar is standing by with a closer look at the numbers. Samit.
So if we see on a consolidated basis compared to last quarter, Bharti Airtel's revenue were marginally higher by nearly 0.7% to close to 20,738 crore rupees. EBITDA was higher by nearly 25% to close to 8,289 crore rupees. Now, this was also because of the adoption of Ind AS. Now, because of that, the revenues of the company were higher by nearly 26%, while the EBITDA was higher by nearly 1,500 crore rupees due to adoption of Ind AS 116. On the bottom line front, the company reported its biggest loss of close to 2,900 crore rupees, but that was because of higher costs and an exceptional loss of close to 1,500 crore rupees related to network refarming and various other provisions that the company made in the first quarter. Now, the company's average revenue per user that came in ahead at around 129 rupees, which was the highest in the last 7 quarters. Now, ARPUs were higher by nearly 2 rupees because of reclassification of one segment, and if you see adjusted for this, the actual ARPU of the company would have been at close to 127 rupees per user per month. Now, the Indian mobile operation, now that reported a good set of numbers even after adjusting for Ind AS 116, and that was due to lower customer churn, increasing data subscribers and higher rental that the company generated. Now, the India mobile subscriber base stood marginally low at only 28.1 crore as against 28.3 crore in the March ended quarter, while the 4G subscriber base of the company that increased to nearly 9.5 crore from 8.7 crore a quarter earlier. Now, the churn ratio, that is the attrition rate for the company, that also declined to 2.6% versus 2.8% reported by the company in the March ended quarter. Now, on financial side, if you see, the India mobile operation revenue was higher by nearly 2% to close to 10,900 crore rupees, while its EBITDA saw a jump of nearly 51% because of Ind AS 116. So if you remove that, the EBITDA was actually marginally lower by nearly 2% to close to 2,500 crore rupees, and that is because in the March ended quarter, the company had some one-off cost reversals, because of which the EBITDA was higher in the fourth quarter of financial year 2019. Now, the India mobile mobile ARPU that came in at around 127, which was the highest in the last 7 quarters. The other details for Bharti Airtel numbers include the capital expenditure that the company did in the first quarter, which was close to 5,000 crore rupees lower than what it did in the previous quarter, while the net debt excluding the lease obligation reduced by nearly 22% to close to 88,500 crore rupees, and that is because of the various fundraising initiatives taken up by the company in the first quarter of financial year 2020.
Thanks for that, Somit. State Bank of India may deliver a healthy set of profits for the first quarter as it leaves the worst of the asset quality troubles behind, perhaps. Shefali Malik is standing by with what the street is expecting. Shefali.
Well, strong set of earnings is what we are expecting as far as the profit number is concerned. So we are looking forward to a profit figure of about 4,105 crore rupees. That will be against a loss of about 4,875 in the same quarter last year. However, all eyes would be on the slippages and the provisioning that the bank makes. So in Q4 of FY19, they had slippages of close to 8,000 odd crores. So this time as well, the street is expecting the slippages to be in the range of about 7,000 to 11,000 crores. So anything in excess of that might be a slight negative surprise coming in, and provisioning on some of the stressed names, if that is made higher, then that may weigh down on the bottom line of the bank. So that's one number that we are closely looking forward to. Street especially talking about what they do with the DHFL, especially the provisioning with regards to that. So that may be one key factor to look forward to. Operationally, the numbers are expected to be healthy. We are looking forward to a pre-provisioning operating profit growth of about 24% on a YY basis, and loan growth is expected to be around 15 to 17 odd percent, which will be a very good number in the current scenario. In Q4 they had about 13% loan growth, so it's expected to be slightly better in this quarter, and deposit growth is expected to be around 7% on YY basis. Now, one factor which most of the analysts are talking about when it comes to State Bank of India is that their margins might look up going forward, and that can start playing out from the first quarter itself. And for some of the financial entities, we've seen the agri portfolio give them stress, more so because of the seasonal factor. So for them as well, we can expect some amount of stress in the agri book, and we can expect some better recoveries to come in from the written off accounts. So that may aid their overall earnings this time. And some of the other segments, like such as auto segment, which is witnessing a slowdown, we can look forward to that portfolio as well, SME portfolio. So that's what broadly we'll be looking forward to from SBI earnings today.
All right. Meanwhile, the 1,900 crore stake sale in Group Finance may boost the earnings of HDFC Limited for the June quarter. Shefali, what's the market pricing in there?
Well, yes, that is one factor which is expected to boost their overall earnings this time around. Other than that, the net interest income, that's expected to be muted, a growth of just about 2% That's because in the same quarter last year, they had some funds because of the equity raising that they had done. So on account of that, they had the interest income to the tune of about 200 to 250 crores. So that element will be missing in this quarter, and hence the muted top line. Loan growth in individual mortgage loans, that's expected to remain healthy for them. We'll be closely looking forward to how it pans out when it comes to their wholesale book, fresh lending, as well as the asset quality, if there is any sort of stress visible there. Overall loan growth is expected to remain healthy at about 15%, and we are expecting marginal improvement in the margins from about 3.3% levels that they had in Q4.
Shivali, thanks so much for that. Let's move overseas. US President Donald Trump has escalated his trade war with China. In a tweet last night, he announced a 10% tariff on another $300 billion worth of Chinese imports. Bloomberg's Haslinda Amin spoke to the US Secretary of State Mike Pompeo soon after Trump put out that tweet. She started by asking Pompeo what went wrong at the last meeting for Trump to take this additional decision. Listen in.
For decades, China has taken advantage of trade. Taking advantage of trade versus the United States of America, and taking advantage of trade versus countries in Asia and Southeast Asia. And it's time for that to stop. And President Trump has said, we're going to fix this. And to fix it requires determination, and that's, I think, what you saw this morning. The president is determined to achieve this outcome. What we're asking for is really easy. Indeed, the Chinese had agreed to it at one point and then walked away from the deal.
So what is it? Is it Huawei at the crux of it? Can that be a compromise?
It's not about, this is far bigger than that. This is about the central premise of how trade will be conducted around the world. Is it okay for a nation that was once developing to continue to take the advantages when they're no longer in that status? Is it okay for a nation to put on enormous tariffs when the other counterparty to the trading arrangement won't do that? Is it acceptable to put tariffs and barriers on American companies investing in China when the United States is wide open to those investments? All we have asked for. It's really simple. It's what you, it's the golden rule. It's what you teach your kids, right? Do unto others. We want fairness, evenness, reciprocity. These are core concepts. They're what I spoke about. And when that happens, Asia will thrive, Southeast Asia will thrive, the United States global trading system will thrive. But it cannot be the case that a nation uses protectionism to protect its own goods and uses predatory tactics to deny others' economies the chances to grow.
At what cost? We're seeing PMIs around the world already easing. We're seeing countries around the world, well, revising downwards growth projection. I mean, yes, the U.S. is in a good position, leading global growth, but with President Trump saying that he will tax the hell out of China, there are negative implications.
But negative implications of decades of bad behavior on the part of China.
When you take a look at how the U.S.
Negative implications for every business in this room, and we're going to fix it.
There's greater scrutiny right now on Chinese companies, especially through the Committee on Foreign Investments in the U.S., of which you play a huge role. When you take a look at the Bloomberg data, it suggests that there are about 173 Chinese companies worth about $750 billion actively listed in the U.S. 750, just Chinese companies in the U.S. Could you be sending a negative message to these companies who are interested in putting money in your country?
No, we welcome capital that comes to America every day, all day. What we want to make sure is the basis on which that capital flows into the United States. We want to make sure that American capital that wants to come to this region, to China, can do so on a fair and even basis, and we want to make sure that capital doesn't pose a national security threat to the United States of America. That's a low bar. Those are simple standards. They're what every nation must do to protect its own sovereignty. And so, no, the message we're sending them is come to America, participate. Do so with the rule of law. Do so through transparency. Don't subsidize those countries. Don't create champions with political objectives. Make them economic objectives. And when you do, many Chinese companies will come to America, compete, and be very, very successful. And we welcome that.
For more on this, Bloomberg's Derek Wallbank joins us from our studios in Singapore. Derek, what's caused this sudden move, and what's the set of goods that come under the new tariffs?
Well, I think what's caused this move is a disquiet on President Trump and U.S. officials' part. They say that China was not moving fast enough with regards to purchasing some agricultural products. There's some other things that are involved in there as well, but it all kind of boils down to a feeling within the White House by the president himself that China wasn't moving fast enough, and so this would be just the kick that maybe they would need. Now, you can debate the merits of that all that you'd like, but the simple reality is at this point, there is a threat for a 10% tariff on about $300 billion worth of Chinese goods to come in. Now, in terms of the exact things, we're still waiting on the U.S. to put out a list of product lines, but where it comes in some is this is almost everything else that doesn't have a tariff on it currently. Almost everything else. There might be a couple of exclusions, but this is almost everything else. So this is quite a very big step. And I would also add this. President Trump said it's a 10% tariff, but he also signaled that he's willing to go much higher, even higher than the 25% ceiling that had been there on other tariff lines. So this may be just the start of a ratchet. It also may just be a threat to try and get China to the negotiating table and start making some of the concessions that the American president wants them to do.
We are bracing for a response from China in terms of words or actions.
We are bracing for a response. Indeed, the Chinese came on just minutes ago and said that if the U.S. actually goes through it, China will have a response to that. Now, What that response is remains to be seen, because as your viewers are quite well aware of, I would hope at this point, and if not, they will be very soon, that the balance on this is not even. The U.S. and China do not have an equivalent trading relationship. There's a fairly sizable deficit, China to the U.S. in terms of goods. And what that means is that China can't just sit there and find $300 billion worth of U.S. goods and slap a 10% tariff on those, because that simply doesn't exist. So what you have to be looking for at this stage is, does China look at ratcheting up existing tariff levels on existing tariffed goods, as sort of, raised from 25 to 50, or does China move somewhere else and introduce contagion risks by bringing things that may not strictly be tariffs onto the table? The U.S. has tried to limit that somehow. They said that this does not affect existing commitments related to trying to soften the blow on Huawei. However, since there is such an imbalance, and since China is kind of close to what one might consider tapped out on new tariffs, you do have to look at contagion as being a risk here.
Derek, thanks so much for that. The renewed trade tensions have taken a toll on the oil market too. After the steepest one-day drop in more than 4 years, crude is now set for a weekly loss as well. Investors concerned about growth slowing even further, triggered by the continued tariff war. All right, that's all we have on this edition of Power Lunch. Thanks so much for watching.